Welcome to Management Accounting. We're going to look at a few topics at this time. We'll look at primarily functional budgets in this script. Functional budgets will include um, purchases, labor, material, and sales and other stuff. And as you go through, you'll see a few calculations here and there. Just focus and listen and watch. All right. Thank you. I make notes too. All right. First thing, the terms used to describe specific budget schedules vary from organization to organization. However, most master budgets share common elements. The usual master budget for a merchandising company has the following components as shown in Exhibit 7.2. First one is operating budget, which consists of sales budget, operating expense budget, purchases and cost of goods sold budget, and budgeted income statement, while financial budget consists of cash budget, capital budget, and budgeted balance sheet. Right? Other companies add to or adapt these categories depending on the nature of their operations. For example, manufacturing companies add budgets for raw material, work in progress, and finished good inventories, and budgets for each type of resource activity, such as labor, materials, and factory overhead. Similarly, a consulting for company might adapt the operating expense budget to focus on its major costs, consultant salaries. In addition to master budget, there are countless forms of special budgets and related reports. For example, a report might detail goals and objectives for improvements in quality or customer satisfaction during the budget period. Now we look at preparing the master budget. Now let's return to exhibit 7.2 and trace the preparation of master budget components. Although the process involves a large number of detailed calculations, always keep the big picture in mind. Remember that the master budgeting process provides an opportunity to review key decisions regarding all aspects of the company's value chain. Early drafts of the budget often lead to decisions that in turn lead to revisions in subsequent budget drafts. This cycle may be prepared several times before the budget is finalized. Now, we're going to use this practical example to guide our calculations in the remainder of the script and for the clips to come as well. Let's listen carefully. We illustrate the budgeting process using the Cooking Hut Company (CHC), a retailer of a wide variety of kitchen and dining room items such as coffee makers, silverware, and table linens. Although master budgets normally cover a full year, for the sake of the brevity, this illustration shows only the first 3 months of CHC's fiscal year, April to June. So it'll be April, May, June. Exhibit 7.3 is the closing balance sheet for the previous fiscal year ending March 31, 2001. Let us go down to the exhibit 7.3 first before we do anything else. Alright, so look at this now. Account receivable. You see those. Can pause the video, write this down for me, please. Just pause the video, write this down. You will hear the explanation for these different areas as we go along. Alright, pause the video, write this down. So this now, as I said before, this is the closing balance sheet for the previous fiscal year ending when March 31, 2001. Alright. Now, right here, so 0.4 times March sales is really 40% of sales for March 16,000 and so forth. Alright. Let's go. So, sales budget is first one. Preparation of master budget for the first 3 months of the new fiscal year requires a sales budget for 1 month beyond the 3 months. because CHC bases its budgetary inventory purchases on the following month's sales. The sales budget for the next 4 months is as follows. So the 1 month behind would be July, right? So it'd be 50,000, 80,000, 60,000. July is 50,000, right? The master budget also requires information about the actual sales in the previous month because CHC collects cash for the credit sales in the month. Again, the master budget also requires information about actual sales in the previous month because CHC collects cash for credit sales in the month following the sale. What this means is that they would have been they would have collected credit sales for April in May. Or they'd have collected credit sales for March in April. Follow me? That's what this means. So they would have collected they would have collected the cash for the credit sales made in what? March in April. So the cash will be collected in when? April. For credit sales in March. On average, 60% of sales are cash sales and 40% of sales are what? Credit sales. Sales in March are $40,000 and the 16,000 of accounts receivable on March 31 represents credit sales made in what? March, which is 40% of the what? 40,000 as you would see right here. That's why you got the 16,000 right here. So this 16,000 now is owing from when? From March. It therefore means that in April, CHC would collect the $16,000 in cash. Alright? Uncollectible accounts are negligible and thus ignored. Alright? For simplicity's sake, we also ignore all local, state, and federal taxes for this illustration. Planned inventory levels now. Because deliveries from suppliers and customer demands are uncertain, at the end of each month, CHC wants to have an on hand a base inventory of $20,000 plus additional inventory equal to 80% of the expected cost of goods sold for the following month. The cost of goods sold averages 70% of what? Sales. Therefore, the inventory on March 31 is 20,000 plus 80% times 70% times April sales, which is the following month. Sales, right? Good. It should be 20,000 plus 28,000 equal 48,000. Let's get the 48,000 right there. Alright? Good. Go again. So it is 80% of the expected cost of goods sold for following the month, right? For the following month. The cost of goods sold now average is what? 70% of what? Sales. So you're gonna find the 70% of the sales is in this case the sales for the following month. Remember, this is for March 31, right? It is and the following month would have been April, so it'll be 70%. So therefore, cost of goods sold is 70% of what? 50,000, and then it says that that part of inventory is 80% of what? The cost of goods sold, which would have been 70% of sales. So that's why you get this figure right here, 28,000 right here. Alright. So first you write 70% of 50,000, and if you do the calculation for that, you would write, follow me now please, 0.70 times 50,000. Now if you got 35,000, then you times that 35,000 by 0.80 and you get 28,000. Add that to the 20,000, get 48,000 for your what? Inventory. Alright. As of March 1. On average now, next part, moving on. You should pause the video right this one if you do have it as it. The coconut company. This is the coconut the Coconut Hut Company balance sheet March 31, 2001. Please let us know if you don't have it, alright? So let's go again. And sorry what? On average, CHC pays pays for 50% of each month's purchases during the month of what? Purchase. Now these figures will be guiding our calculations as we go along. Just remember them, alright? And 50% during the next month. Therefore, the accounts payable balance on March 31 is 50% of March purchases, right? Or 0.5 33,600. And the March purchases was 33,600. So they'd have paid 50% of it, right? And the remainder will be left to that will be paid for in when? April. Alright? So remember watch those the good terminologies, please. Wages and commissions now. CHC pays wages and commissions twice each month, with payments logged half a month after they are earned. Each payment consists of two components. Sorry, one half of monthly fixed wages of 2,500 and two commissions equal to 50% of sales, which we assume are uniform throughout each month. To illustrate, this will really mean half of monthly fixed wages, right? Will be half of 2,500. Alright. To illustrate the wage and commission payments, the March 31 balance of accrued expense of accrued wages and commissions payable is zero point 0.5 times 2,500 plus zero point 0.5 times 15% of 40,000 should be which should be 1,000. This 1,250 right there is half of 2,500. The 3,000 is 15% of 40,000. Sorry, the 3,000 would have been half of the 15% of 40,000. Now, 15% of 40,000 would equal to 6,000. Now you would half it to get the what? 3,000. And I'll give you 4,250. Because of the half month lag, CHE will pay this 4,250 balance on April what? 15. So this is how you have the accounts, accrued wages and commissions payable at this moment, alright? For that section. Let's go now. Capital expenditures and operating expenditures. Now, CHC's only planned capital expenditure is the purchase of new fixtures for $3,000 cash in April. Alright. CHC's monthly operating expenses are as follows: 5% of sales, miscellaneous expenses paid as incurred, rent 2,000 paid as incurred, insurance $200 expiration per month, depreciation including new fixtures $500 per month. Alright, let's move on. Because collections lag credit sales, CHC often struggles to come up with the cash to pay for purchases, employee wages, and other outlays. To meet cash needs, CHC uses short-term loans from local banks, paying them back when excess cash is available. CHC maintains a minimum of $10,000 cash balance at the end of each month for operating purposes and can borrow or repay loans only in multiples of 1,000. So that means they are paying back loan, right? Assume that borrowing occurs at the beginning and repayments occur at the end of each month. Every month, also assume that the interest of 1% per month is paid in cash at the end of each month. These information will be used later on when you are doing the cash budget. Alright, good. Now we look at steps in preparing the master budget now. The principal steps in preparing master budget are as follows. Using the data given, prepare the following. So using data given above, prepare the following budgets and schedules for each of the months of the planning horizon. So you could look at this sales budget first, You look at cash collections from customers. These are schedules. Look at the schedule for purchase and cost of goods sold, budget, schedule for cash disbursements for purchases, schedule for operating expense budget, schedule for cash disbursements for operating expenses. Operating budget now. Using this operating schedule, budgets and schedules, prepare a budgeted income statement for the 3 months ending June 30, 2001. You see that being done as well. And then last and now, prepare the following budget and forecasted financial statements. Capital budget, cash budget now, including details of borrowings, repayments, interest for each month of the planning horizon. And your budgeted balance sheet as of June 30, 2001 as well. Alright, so all of these we're going to do step by step, right? Organizations with effective budget systems have specific guidelines for the steps and timing of budget preparation. Although the details differ, the guidelines invariably include the preceding steps. As we follow these steps to prepare CHC's master budget, be sure that you understand the source of each figure in each schedule and budget. Let's go. First one, look at the sales budget. So step one is the first thing, prepare basic data now. So we look at the sales budget is the starting point for budgeting because planned inventory levels, purchases, and operating expenses all depend on the expected level of sales. Schedule A includes information about actual March sales because March credit sales affect what cash collections in what April. So this is the sales budget. 5,000 for March, 50,000 for April, 8,000 for May, and June 60,000. And where this come from? This comes from right here. All right. Let's continue. That was the sales budget, right? Now we'll look at the cash collections part now from customers. What is now? Schedule B now uses the sales budget to plan when CHC will collect cash. In turn, we will use Schedule B to prepare the cash budget in step 3. Alright? Now, cash collections from customers include the current month's cash sales plus what? Collection of the previous month's cash sale. Alright? Now, for cash sales now, 60% of current month sales now, which is 60% of 50,000 give you what? 30,000. 60% of 80,000 give you 48,000. And 60% of June amount, which is 36, give you 36,000, right? And your collection, the collection of last month's credit sales, 40% of previous month's sales is 40% of 40,000 would have been 16,000. For me, it would be 40% of what? April amount, which give you 20,000. For June, be 40% of what? May amount will give you what? 32,000. Add them up together, you get the total collection, which is 46,000 for April, 68,000 for May, and 68,000 for June. So this now will help you to do the cash budget in step 3 when we get there. Alright, good. Let's move on. So I would ask you to pause the video, write some for me please. Thank you. Pause the video, write some for me please as well. Thank you very much. Now we'll look at purchase budget. Let's go already. Now we'll look at purchase budget. Now let's go. Ready? Elements of purchase budget are tied together by a simple, intuitive identity that ignores minor complications such as returns and defects, but relays the fundamental uses of inventory to the sources. Inventory is either sold or else carried over to the next period as ending inventory. Inventory comes from either beginning inventory or purchases. Therefore, cost of goods sold plus ending inventory equals beginning inventory plus purchases. We budget cost of goods sold by multiplying the cost of merchandise sold percentage. 70% by budgeted sales. Alright? Again, we budget cost of goods sold by multiplying the cost of merchandise sold. So let's go again. So inventory is either sold or else carried over to the next period as ending inventory. Inventory comes from either beginning inventory or what? Purchases, right? Therefore, cost of goods sold plus ending inventory equals what? Beginning inventory plus purchases. We budget cost of goods sold by multiplying the cost of merchandise sold percentage, which is 70% by budgeted sales. The total merchandise needed is the sum of the budgeted cost of goods sold plus the desired ending inventory. Alright? Go again. The total merchandise needed is the sum of budgeted cost of goods sold plus the desired ending inventory. Finally, we compute required purchases by subtracting beginning inventory from what? Total merchandise needed. Alright, so look at this now. Look at this sales budget. This purchase budget now. Budget cost of goods sold is 35,000 for April. How did you get this? Hmm? We budget cost of goods sold by what? Multiplying the cost of merchandise sold percentage 70% by what? Budgeted sales. So therefore, to get 35,000, you would multiply the 70% by the amount of sales for what? April, which would be 70% times 50,000. And that's how you get what? The 35,000. So to get the 35,000 right here, you multiply 70% by what? The budgeted sales. Good. To get May 1, you multiply what? 70% by the 80,000, get 56,000. And if you get June, now you multiply 70%, which is the 70% here. 70% by what? 60,000. And then you get the figure of 42,000. So those are the budgeted cost of goods sold. Alright. Now there is a plus desired ending inventory. Now what is this or desired ending inventory? Hmm? How did you get desired ending inventory? Let's look at it now. To get desired ending inventory is really 20,000 plus 80% of the next month cost of goods sold. Watch this. So therefore, to get 64,800 is really 20,000. Follow me? Plus, so this, as you see the calculation here for this line. Now this now for this line now is 20,000 plus 80% times what? Next month, so it should be 80% times 56,000. Let's go. 0.80 times 56,000 plus 20,000 will give you 64,800, right? So you're good. 80% of what? Next month cost of goods sold, which is this one, right? So therefore, to get the 64,800, this is what? 80% of the 56,000 for May. Good, good. It's upcoming, miss. Anyways, let's see now. All right. So that's for that for April. For May now, it will be 20,000 plus 80% of the 42,000, right? Should be 0.80 times 42,000 plus 20,000. I say 50,600, right? Now for June, let's go to June now. For June now, it will be 80% of the next month cost of goods sold. Now remember that we did some when we did something, we'd already included in what? We included July, right? So therefore, July now, July sales will be so we'd have therefore we would find 80% of this 50,000 now, and then add it to the 20,000. So you find 80% of 50,000, right? Then you would, what did I say? Sorry. Oh, lie. Before, it would not be like that. Sorry, folks. First thing is you do. First thing you should do in this case now. You would find 70% first, sorry. You would find 70%, my apologies. 70% first of the 50,000, my apologies to the folks. It will be 0.70 times 52,000. Sorry, times 50,000. 0.70 times 50,000. That'll give you 35,000. Then now, you multiply 35,000 now by 80%. You get 28,000. Add the 28,000 now plus 20,000. You get what? 48,000. Now that calculation is shown right here. Right some right where is it now? Let me see now. Alright. They say like this now, so look at this now. Purchases from March or ending inventory 48,000 as shown exhibit 7.3. Because of goods sold, it's 0.7 times March 40,000, says right? So let's begin inventory will give you 20,000 plus 80%. No, what I did it slightly differently a while ago. So what I would do is find 70% of the 50,000 a while ago, which is right. So you'd find 70% of the 50,000 of the 50,000 first, then you'd find 80% of the cost of goods sold as you would have done before, which would have been the next month, which is July. So you'd find 70% of the what sales for July, which is 50,000. So you find 70%, go again. You find 70% of the sales for July, which is 50,000. That amount would give you a budgeted cost of goods sold for what? July. Then you find 80% of the budgeted cost of goods sold for July. I add it to 20,000, which would have been, which would have given you 28,000. I add 28,000 to 20,000, you get 48,000, right? You add up these now, you get your total merchandise needed. Good. And then now you subtract your beginning inventory. Now the beginning inventory for April would have been the ending inventory for March. Follow me. Go again. The beginning inventory for April will be the ending inventory for March. So therefore, see here, this $48,000 now would have been our ending inventory for March, but beginning for what? April. So 5,599 will give you 51,800 now. For May, what will be our beginning inventory? Hmm? Would have been our what? Ending inventory for what? April, which would have been the 64,800 right there. I put it right there. Good. And the beginning inventory for June would have been the ending inventory for what? May. 52,600. So therefore, you subtract these now. I get these now would be your purchases for April, May, and what? June. You have a purchase for the purchase here for March, which is 33,600. All right. That's what's kind of. It is not normally as complicated as this, but it's just if it comes like this, you have an idea of what to do. Pause the video, write this information down. Thank you so much. Let's move on. So the part about cash disbursement for purchases now. We use purchase budget to develop Schedule D. In our example, disbursements are 50% of the current month's purchases and 50% of the what? Previous month's purchases. Alright, let's go now. So the first one now is 50% of the current month's purchases and 50% of previous months. Right? So we look at the previous month's one first, right? So the 50% of the last month, which would have been March, which will be 50% of what? 33,600, 0.50 times 33,600, and that will give you 16,800. Then 50% of what? For of April for me, 0.50 times what? 51,800, and that gives you 25,900. Then 50% of the amount for May, let's make sure you clarify, the purchases for May, right? So 50% of the purchases for May, which would have been 0.50 times 44,800, that will give you 22,400. And that would be that for that. Then you would want to find 50% for this month's purchase now. You're going to find 50% now of the amount for what? April, May, and June each. So you have 50% of April with 25,900 already. So it will be 0.50 times 51,800. That gives 25,900. Hope you are calculating with me, Then you have 50% of 44,800, 0.50 times 44,800, 22,400, then 50% of the June one, which is 0.50 times 36,400, and I give 8,200. That would be that for that. Add those together, I get a total amount of disbursements that will be done for the month of April, May, and June. These are money that will be used to pay for the purchases conducted. Thank you for watching this video clip. Please stay tuned and look forward to the other video clips coming up shortly.